Good morning and welcome to this Wednesday, October 7th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we got futures pointing up this morning. I'm sure there were a lot of nervous folks last night. Of course, yesterday afternoon, right around 3 o'clock, maybe a little before, President Trump came out and said he was cutting off talks with the Democrats for the fiscal stimulus plan, and the market sold off, as you probably would imagine. I think the market was expecting some sort of stimulus. There was a lot of optimism around some stimulus, and so big sell-off in the last hour and 15 minutes. And then later yesterday, or maybe it was even this morning, I saw the news this morning, that President Trump came out and said, well, we'll still consider individual measures to help, but that the overall stimulus package, I think, is what's maybe more in question at this point. Anyhow, the market reacted much more favorably to that, and currently we've got futures up a little under 1% this morning, so it looks like we'll have a pretty good start. I'm going to get into what happened yesterday and do all that in just a minute, but I do want to point any of the folks here who maybe are new to Earnings Beats to go to earningsbeats.com. We do have a free Earnings Beats Digest newsletter, comes out Mondays, Wednesdays, and Fridays. Had a good article this morning on a media agency company that I think looks pretty strong, and the group is beginning to show some strength. So you have to maybe check that out. But anyhow, all it requires is your name, email address, hit that subscribe button. No credit card required, completely free, and you can unsubscribe at any time. And if you want to just jump in, check out our service, you can hit this green Join Today button. We'd love to have you. You can see below the portfolio returns that we've enjoyed this quarter and since inception on the various portfolios. We talked a lot about relative strength, earnings, the importance of beating earnings estimates, revenue estimates. We even keep chart lists, not just for strong earnings, but for strong future earnings, raised guidance, strong accumulation distribution. I mean, there's a lot of different work that we do, a lot of research. And if you're well, everybody can view those chart lists, but if you're a Stock Charts member, Extra or Pro, you can actually download all of our work, all of our chart list right into your account. It's a pretty cool feature. And when you join, it's basically a no-cost trial, $7 for 30 days. And then beyond, well, after a week, we refund it. And then beyond that, you have your choice of monthly or annual, and the annual saves you a ton of money. But anyhow, just wanted to point that out for anyone that might be new to Earnings Beats. All right, let's jump into what happened yesterday, because we had a pretty decent day going. And then, 3 o'clock, everything turned sour, and I'll show you that in just a minute. But you can see the Dow Jones finished down 1.3%, S&P 1.4%, NASDAQ almost 1.6%. Mid caps down almost 0.5%. Small caps relatively flat on the day after being up much more earlier in the day. But you can see some pretty good relative strength. Look at the mid caps all of a sudden here over the past 2 or 3 weeks, moving up, trying to make a breakout above the double top that we saw in August and September. And small caps not far from breaking out from where we were in August. Now, when you look at that compared to the others, you can see there's definitely been a rotation into mid and small cap stocks. And many of those mid caps and small cap stocks were probably hurt the most by the virus. Many of those companies depended on loans. Of course, banks not doing as well, a lot more loan losses. So I think availability of credit was slipping a little bit. And for whatever reason, the mid caps, small caps had underperformed. They underperformed going into the pandemic, but they really took a toll on many of these small companies throughout the pandemic. So when I start to see these groups do better, that gives me some really good feelings, not just about the overall market, because when you get small and mid-cap stocks moving higher, that generally is going to be part of a secular bull market move. But I think it also speaks volumes about what the market is thinking about the virus and the market beyond the virus. And so, as we look out toward 2021, I think the market is beginning to tell us, hey, we're going to be beyond the virus. Now, I know what we're seeing in the news. I'm just telling what the market is saying. And to me, that's the most important thing as an investor, is what the market's saying, not what folks are saying in the media. And so I think this is a positive sign that we're seeing here in mid caps and small caps. And personally, I hope it continues, even though that's not an area that we've really been focusing on because those are areas that have underperformed. I want to see full wide participation in this move to the upside. And these are two groups that have been lagging pretty badly. So I think it's good news. You can also see the AD lines on both that were faltering in September have come rallying back during this move. So this is not just prices moving up, being manipulated perhaps, but this seems like real buying and real accumulation. I think that's a good sign for the market. Utilities breaking out. Another group, we talk about wide participation. Would I be rushing into utilities? No. But am I excited by the fact that utilities are participating? Yes. I want to see more and more groups. I want to see energy start to participate. That's been the one real big laggard. I mean, we can look at utilities, we can look at maybe real estate and staples and some of those areas, some of the more defensive groups that really haven't been, skyrocketing. They've just been going sideways. You can see that here on the utilities chart. But they are starting to perform better, which I think is a good sign. Communication services already were performing very well. They got some, there was some profit taking, but the good news is that we've seen profit taking here. We're seeing the money rotate into some other areas that had not been doing so well. And then you've got discretionary, which didn't have a very good day yesterday, down almost 2%. But prior, at the high yesterday, not too far from breaking out. That, again, is a very good sign. Discretionary stocks are probably the group I follow the closest, that along with technology. But, what people are doing with their money when they spend it, are they spending it on the things that they want or the things that they need? What's that ratio? Discretionary versus staples. That, to me, is one of the most important ratios in the market. And discretionary trying to break back out again, I think that's a great sign for our market. Renewable energy, best performing industry group for the second straight day. That doesn't happen very often. 104 industry groups. Renewable energy, number one, 2 days in a row. A lot of money pouring into renewable energy. A lot of the leaders, we're talking about Solar Edge, Enphase, Jinko Solar, which has been an absolute massive short squeeze. SunPower, another short squeeze. These stocks have been going up day after day after day, and I think that bodes really well for their upcoming earnings reports. Non-ferrous metals, not really doing much. Yesterday, down almost 4%. Well, I should say they are doing plenty. They're just doing it to the downside. But the overall, trend here is up. We pulled back September, started to bounce. We're in a trading range right now. Yes, it was down 4%. It was a horrible day, but I don't read anything into that other than the fact it's just consolidating. The 10-year Treasury yield. Let me get an update on this, make sure we got the latest here. Right now we're at 0.777, so almost 0.78%. I love this breakout, though, above that 0.75 area. That could lead, and the reason that I'm watching the rotation so closely right now is because of this breakout. If we were, looking at the market moving higher, but the 10-year Treasury yield was remaining down around 0.7 or 0.65, there's no doubt in my mind that the money coming into the market would rotate towards growth. Low interest rates, historically low interest rates, not moving higher, money coming into the stock market, almost guarantee. Can't guarantee anything, but I would feel really comfortable that growth was going to get the majority of that money. Well, with the 10-year Treasury yield breaking out and people moving away from treasuries, that tells me the reason that you move away from treasuries is because of a strengthening economy. Either a strengthening economy or you're expecting a strengthening economy. That's why you get out of treasuries. That's why you get out of the bond market. And so if that's the case and the economy is going to strengthen, we're going to see transports run. I wrote about transports recently. If transports are running and they're breaking out, that tells us that our brick and mortar companies, the real guts of our economy, are expected to strengthen or are strengthening. And that could lead to rotation away from some of these growth stocks and into some of the value stocks. And we've seen some of that recently. I'm going to talk about this a little bit more later in the show. So I'll save that. But the breakout here at least tells me to be thinking that, hey, I believe market's going higher. Don't get me wrong. I'm not talking about us just going sideways in rotation. This group goes up, this group goes down. I think the majority of the stock market's going higher. The question, though, is which group leads, which groups lead. And with this breakout, that muddies the water. I'm not quite sure what to look for in terms of leadership, and I'm going to follow what the market tells me. And the market's been telling me keep this in mind here over the last week. You see that big move? Because I'm going to show you industry groups and their relative strength over the last week later in the show. And it kind of ties back to this move in the 10-year Treasury yield. All right, in the news this morning, we got Integra Life Sciences. They actually guided their Q3 revenues higher. Stock, last time I looked, was up almost 6% in pre-market. Not a big fan of the stock. I think there's other places to look, but maybe this is the start of something, the fact that they're guiding higher. Another company guiding higher, Luminex. This is a company that guided their Q3 revenues higher also. But once again, look at the action heading into this. We've started to strengthen a little bit, getting some good news. Stock up about 2.5% in pre-market. Again, last time I looked. But overall, I'm not so sure. We've got a lot of overhead resistance, gap resistance. This still isn't one that would overly excite me. Next up, Perion Network. Now, this one's been trending higher for the last 6 months, 7 months, really since that March low. Volume trends have picked up. The overall volume, I would not pay much attention to this stock because it just doesn't trade enough volume for me. Not something that we would really cover that closely at earnings beats, but I just wanted to point it out. Stock's up 13% in pre-market, and they guided fiscal year 20 and earnings per share, fiscal year 20 revenues and earnings per share higher. So already stock had broken out, I think, in anticipation of the news. Look at the volume coming in. I'm not saying anybody knew this was coming, but it certainly looks like somebody may have known something was coming, if that makes any sense. And the last one I wanted to mention, and this is one I talked about earlier this week and maybe even in the last week, I think it was earlier this week, DraftKings. They came out with a secondary offering, and my experience is if you own a stock, especially if you're a short-term trader, if you own a stock and it comes out and says something about a secondary offering, hit the sell button. Just don't ask any questions. That's not to say it can't go higher. I've seen some go higher. If the market anticipates that the money being raised is in some way going to help, drive earnings per share higher, maybe they're raising money to buy a company that's accretive. I mean, there could be a number of reasons why a company could be raising money that could add, real value to the bottom line. But most of the time, it is just not good because usually they announce a secondary offering, which is an initial move to the downside, and then they come back later and announce the pricing of the offering. Now, right now, DraftKings is trading at 56.78. So when they announce the pricing, if they say the pricing's at $60, who's going to buy those shares at $60 when you can buy the stock at 56.78? The pricing is always lower than the current price. Well, DraftKings came out today and announced that they're going to offer at $52. Now, you can go back and listen to my show. I'm pretty sure it was on Monday morning. I said back then, expect DraftKings to go lower. It was trading after the news. They had come out. The stock was down around $61 or something. In pre-market today, it's down another 8%. So we're talking back down close to that $52 level. Because again, if you're going to offer shares at $52, who in the heck's going to pay 53 or 54? You got 52 getting ready to flood the market. I wouldn't be surprised to see DraftKings go down even further. Eventually, I think this will turn out to be a great buy. Stock had a lot of momentum. I think there was a lot of accumulation taking place. Look at all the volume coming in. You look at the stock relative to the S&P 500, it's been a great performer. It'll probably overshoot to the downside. Many of these stocks do, and I've got another segment later in the show. I'm going to talk about secondary offerings, so I want to keep moving here. But just to point out, this stock is in the news today, down about 8% based on this offering. All right, let's move on to talking technically. And in talking technically, I just want to point out the S&P 500 after this move to the upside. Normally, when we're moving higher, and I believe we're going to keep going higher, which I do now, I think we're going to break back out again. I think we'll be trading at all-time highs in the fourth quarter, probably sooner rather than later. But when I see this move up and I see a correction, I start looking for a continuation pattern. And what I see here are two possibilities. One, an inverse head and shoulder. So here you come down, put in the left shoulder, rise to put in the neckline, go to a new low, an ABC correction. That puts in a lower low for the head. Come all the way back up. Now, in a downtrend, you would struggle at resistance here. You set a low, you go up, and then you break below. Well, TA 101 is broken support becomes resistance. So we should have failed at that 20-day, but we didn't. We went up through it and went all the way back up to test this prior reaction high. That could be the right side of a neckline. If we pull back and get back down, I'm going to say 3320-ish, 3330, that could put in the right side of a rather symmetrical inverse head and shoulders. Now we got futures up today. Who knows, how we finish. I'm just pointing this out as a possible pattern to watch. We could still pull back one more time, get a little above 3,200 and then break out. That would be an inverse head and shoulder pattern breakout. The other thing I would simply watch is, kind of a rounded bottom. If we keep going higher, I'd look at this as a cup. Both of these patterns are continuation patterns. Both of them are bullish. Both of them, we anticipate that the move is going to continue to be to the upside. So just wanted to point that out, maybe take a look at that as time goes on. But that's what I would be viewing. Now, a negative, certainly in the short term, maybe even in the intermediate term, would be to go down and lose 3,200 support. That would make me reevaluate what's going on in the market. Until we see that, technically 3,200 or 3,210, whatever that low was, that becomes pretty key support. We could go down, test it, bounce. We could do that for the next couple months. Who knows? No guarantee we're going to get a breakout. But I do think eventually we break out. Watch that 3,200 level to the downside, though. All right. The next thing I wanted to point out was this relative strength of the industry groups. So this is a chart list that we have, and all of our members can download. If you're an annual member, we do require an annual commitment to us because this is a chart. Once you have it, you have it. It doesn't need to be updated. There's 104 industry groups on here. And what I do, and I think this is so easy, is I bring this up in summary form. And once I bring it up in summary form, and I can, let me show you how I get into this. So let's just say you're looking at a stock or whatever, Goldman Sachs, and you say, oh, I want to see what's going on with the industry groups. Well, you got to go down, you've got to find your industry group relative strength chart list. Then you've got to bring it up, view all. So hit that view all button. Then it brings it up. My default here is 10 per page, but bring it up in summary form. Now, what I did is I went back and changed the period to a week. I told you that that 10-year treasury yield was moving up over the last week or so. That's kind of different. We've broken out. So when I see something different in the market, I want to know what's going on underneath the surface. Don't tell me what the S&P did. I can see that on a chart. That's what CNBC tells you. Oh, the S&P 500's up. And then they bring in their parade of experts. Yeah, the S&P's up. Wonderful. I want to know where the money is rotating to. So when I look at the last week, I can see what this break in the 10-year treasury yield, what the initial stock market reaction has been to this. We got energy, we got financials, we got industrials, real estate, utilities, finally communication services, although that's media agencies. I just wrote about them. How? Because of this chart list. This is what made me aware of it. Materials, real estate, financials, utilities. Do you see what's happening here? The top groups over the last week are changing. That's important to know. I don't know if it continues. I'm just saying it's changing, and we need to be aware of it. It could certainly influence our portfolios in the next quarter if this continues, because we've been in these groups that have been leading, and we've enjoyed tremendous success. And you might say, well, why get away from what's working? Well, when the market tells us to get away from it, we get away from it. I'm not saying that we would change our portfolios now. I'm simply saying this is something we need to monitor over the next several weeks throughout earnings season. If we start getting all these reports from technology, consumer discretionary companies, and they're off the charts, good, but they start underperforming on a relative basis, the market is telling us something. We need to continue to watch this. So this is something that's changing over the last week. Now, we saw this back in latter part of May and early June when the 10-year treasury yield went up. And what happened? The groups fell apart. They didn't continue. And the money rotated right back to growth stocks and away from value stocks. So I'm not saying this is changing. I'm just saying we're seeing what I would expect to see with the 10-year treasury yield breaking out. And we'll have to see if this continues, especially if that treasury yield starts to pull back and the money still rotates into these groups. That would be a really significant development. All right, next I want to talk about scooter reports. Now, when you see these scooter reports coming across here, this is one of the things that we can look at on our dashboard at Stock Charts. And we have different things that we can pull up. So I could pull up market movers, sector summary, scooter reports, which is up, ticker cloud, predefined alerts, decision point signals, if that's something you follow. So we've got different options here. Now, if you're not seeing these panels on your dashboard, go over here to the gear and make sure that chartless panels, additional data panels are showing up. If that's not checked, that's why you're not seeing those panels, those 3 panels going across there. Make sure that's checked. All right, but when I look at this, you might look and say, well, the top down, all these are bad stocks. And I would just caution you not to make that assumption. In fact, if you think about it, if the worst stocks in the market are going to have scooter scores around, 0, 1, 2, maybe single digit into the teens, those are the worst ones. They're probably not going to be on the top down list because they're already so low. If you've got a stock that's got a scooter score of 4, the most it can go down is 3.9 to 0.1. So it isn't going to hit this list. The big changes are generally going to come from stocks that have been pretty good because those are the ones that have high scooter scores and can fall much quicker. So when I'm looking here at top down, I usually look at what the scooter is. And if I see the scooter here in the 50s or 60s and it's down 20 or 25 points, that's telling me it had a pretty high scooter score before yesterday. And maybe this is an opportunity. Sometimes scooters will drop back into the 50s and 60s and then turn right back around and go back up into the 90s. So I would pull up a chart like this. Now, is this one that I really like? Well, recently it's been pretty good. I would be watching this support level right here. I think we could go down and hit that 85 level. And if we got a reversing candle, let's say we had an intraday move down to 81 or 82, came back up and closed over 85, that might signal time to maybe trade the stock on the long side. So it's one I could be interested in. I certainly wouldn't go rushing into it right now. What we're seeing is look at the AD line. Look at the volume picking up on the sell. Look at yesterday's candle. That's an ugly candle. Failure at the 20-day. Big, filled red candle. This doesn't look great to me, but an uptrend is higher highs, higher lows, higher high, and you just don't want to put in this new low. So this is one that certainly could reverse from 85 bucks. So really that's what I wanted to point out in scooter reports. Just if you're going to use these, don't think too literally about it. Use some common sense. Some of these stocks, PLMR 71 down 21, that means it was at 92.9 prior to this drop. Does that mean it's a good buy? Well, I don't know. I mean, we got, highs. Here's your reverse to the low. Here's this move up. A lot of volume. I mean, this thing could make a move down here into the 75, 80 area. But there we might see a reversal and a push back to the upside could become a nice short-term trade. So that's all I wanted to mention there. Let's move on to chart lists. This is a new feature. I just like to go through and point out some of the things working and not working in our chart list, give you a sense of maybe if you're not a member or a new member, some of the things that we look at and some of the uses of these chart lists that we put together. So LQDT was the best performing strong earnings chart list stock. And this is a good example when I look at this of being careful of using the AD line as your primary indicator. AD line is a secondary indicator, just like the PPO, like the RSI, like MACD, like anything else that we put on our charts. That's secondary. What's primary? Price resistance, price support resistance, along with volume. Price and volume. That's my number one go-to. Nothing on the chart is more important than price and volume. Not the moving averages, not the AD line, not the, relative strength, even though all those things are big. Price volume is the most important thing. And I'm going to show you on this chart what I'm talking about. So here was your breakout right here. That's where that high candle body was. We pulled back, we broke out. Look at the volume. That volume confirms the breakout. We went down. Where did we put in a low? Look at the AD line. AD line was horrible. And while it was pulling back here, relative strength was weakening versus the peers, versus the S&P 500. I mean, if that's the only thing you're looking at, you would say, oh, I'm not buying this. I'm going to short it. Look at the AD, it's weak. That's if you were using that as your primary indicator, and you'd have been dead wrong. Don't ignore price support with a stock that is looking like it's failing. I mean, here it's coming down. It loses its 20-day. That day it was losing its 50-day. But notice right when it got to price support, buyers came in. And we had a couple trips down here before we did this. Can't emphasize that enough. Price and volume, number one in terms of indicators, or just, your primary trading indicator. All right, let's take a look at the worst performer. I'm not going to go through all of the different chart lists today, but I'll bring you up just a couple of them here. So this is the worst performer on our strong earnings chart list. Well, I mean, to me, it looks like the stock's broken down. It's trading down below its moving averages. Volume trend still not that bad. Huge move up. I think maybe we just go down and hit this gap support. I would have expected the top of gap support to hold, and it didn't. But the volume on the breakdown hasn't been that great. It's still in a pretty good group, but Groupon relative to its peers is actually moving back down close to a 52-week low, and it did lose the top of gap support. I'm not a fan of just jumping in at this point, but I'd be aware of the bottom of gap support. We might see a reversal there. All right, the other chart list I wanted to show you is the short squeeze chart list. So our top performer in the short squeeze chart list, now I'm always looking at this. I like to look at top performers in the short squeeze, because if you get a stock that's breaking out, especially over a base, most of those that are on the short side are underwater. Now, in this one, we've been downtrending for a while, so I don't know that this breakout necessarily is going to send shorts to the exit, but it's at least nice to be aware that, hey, this is a stock breaking out to about a 6-7 week high. Not intraday. We saw some higher highs, but it is starting to break out. Another thing, I'm not a big fan of trading stocks under a couple bucks, so 64 cents doesn't really interest me. I wouldn't do it, but it is on our list, and the stock did make a breakout on big volume. Actually, when I say big volume, 4.8 million shares seems like a lot, but when you multiply it times the price of the stock, the dollar volume really isn't that great. We're talking about maybe $3.2 million. That is not very much for a stock in terms of dollar volume. But the other one I wanted to mention that was up there right behind this stock was a stock that I've been talking about, Bloom Energy. And when it pulled back the other day, I talked about it when it was the worst performer, and it hit that 20-day. And what I said was, you want to watch this stock because it's in a bullish pattern. And if it could get that breakout above 19, could really trigger the beginnings of what could be a significant move to the upside. Well, we bounced off the 20-day, and in 2 days, we went right up, and look at the volume picking up. Bloom Energy definitely looks to me like a potential short squeeze candidate here. This one, off of this pattern, looks like an ascending triangle. This thing measures up another $7, $8. So 26 to 27, maybe even 28 would be the measurement. Watch today. If this gets another boost, I would expect that we're probably going to be in the midst of a short squeeze rally. Worst performer, and I don't look at worst performers on short squeeze chart lists because usually they're bad performers to begin with. And when they're in a downtrend like this, I have no interest whatsoever in trying to time a bottom on a short squeeze stock. Many times these companies that are heavily shorted for a reason. It's only a small number of stocks on this list that you really want to be interested in on long side. Don't just look at a stock and say it's heavily shorted, I'm bullish. That, I think, is a completely wrong way to look at it. In fact, most of these stocks on this list, I would be very bearish. But when they start to make a breakout, that's when I start to turn more bullish, because the market is filled with short-term market inefficiencies, and short squeezes are one of those, where for whatever reason, in this case, a lot of people betting against the stock, you have folks that are very interested in buying to ease the pain because they're shorting, they're underwater, the stock's going up, massive volumes coming in, and they usually don't go up 0.5% today, 0.33% tomorrow. Take a look at Jinko Solar. Stock broke out at 29. It's at 49 2 weeks later. That's what I'm talking about in terms of pain for short sellers. It's an emotional game when they start to go against you. Short selling, is great when you're right, but when you're wrong, man, does it get painful. And the thing is, most of us, being human, are very stubborn. We're very stubborn by nature. We believe we're right and the market is wrong. So not only when you get a breakout do you see, folks saying, putting their foot down and saying, hey, I'm short and this thing's going to go back down. But a lot of times they keep shorting and they're just building up ammo for a bigger and bigger and bigger advance. I think that's exactly what happened with Tesla as it kept going up. You had a lot of shorts, some of them on CNBC talking about this company's worth $10. I don't know what they're saying now that, after, if we adjust for the split, it's over $2,000. But again, we can be very stubborn. All right, secondary offerings. I'm going to go through this real quick. So I talked about DraftKings. Let me pull this one up. So DraftKings, and I'm going to give you an update. We'll see where it is now. Get a live. Look at it down to $53 now. So they come out, I think it was 52 they priced at, so a little bit higher than that. I would not be surprised to see the stock down in the 40s. Now, would I short this stock after it's already down 10? I think part of the opportunity has been gone. I don't short anyway in a secular bull market. I mean, that part of my strategy is not even a thought. There are so many stocks going up. I'm not going to try and find the 10 or 20% that are going down. Why not look for the 80% that are going up? I just don't even understand why you would short in a bull market. Similar, when you're in a confirmed bear market, trying to go long the market is very difficult because you just go one leg after another to the downside. Most stocks are going lower. You're trying to find that needle in the haystack that's going higher. Makes no sense. Go with the flow. Go with the trend. The trend is your friend. I'm sure you've heard that plenty of times before. As a trader, I always want to go with the trend. So I would not short DraftKings. If I ever did short, though, in the market, it would be with these secondary offerings. Let me show you another stock. And I feel bad because this is a stock that I mentioned on a breakout. And then the stock came out, and I actually owned it. I got hit with this thing. Look at Forterra. Breaking out. You got to think about the logic behind a secondary offering, too, and just the common sense. If you're management, you're the board of directors, you need to raise capital. If you've got a stock that's $15 or $20, let's say it's $20, just ABC company, or $20. You think your company is worth $30. You think the market is undervaluing your company. Would you want to offer shares at $20 or $18? You're probably going to have to go lower. So would you offer shares at $18 if you think your company's worth $30? No. Board of directors, management teams, they get together and they announce a repurchase agreement. They want to buy shares in their company, even if they have to borrow. If they believe their company is undervalued, they are not going to come out with a secondary offering. So a lot of these secondary offerings, if you look, most of them occur after a big advance. Companies take advantage of this huge advance and they say, okay, now we're going to do a secondary offering. Now, in the case of Forterra, when they announced, and they announced it after they closed at 17.5, I was in it and ended up taking a loss. Stock gap down, made a little bit of a rally, and then headed lower. This was a selling shareholder that wanted to sell, I think it was 10 million shares, which was like 10% of the company. And the company was not going to get any of the proceeds. It was just one big owner that wanted to sell. Well, that doesn't even look good for the company. So look at what they did to this stock. I mean, just absolutely trounced it. Now, down here at the bottom, do you know, in our daily market report, off of this downtrend, when it finally reversed and put in a higher high, it was provided in our daily market report as a downtrend reversal candidate. And look at what has happened to the stock since then. This wasn't a bad company. It's just when you get that secondary offering, especially a selling shareholder that doesn't net any proceeds for the company, all it is bad PR for the company for a period of time. And I certainly didn't expect this kind of move to the downside, or I probably would have shorted it. But this, again, was a secondary offering, and take a look at what happened. Look at First Solar. First Solar, right up here. I don't remember if it was this high or this high. I'd have to go back and look. But one of these highs, they announced the secondary offering. And I think it might have been right here. Look at the move down, but now look at the recovery. These secondary offerings are short-term inefficiencies because you're adding supply. So when there's no added demand, but all of a sudden you're adding shares, you're adding supply, there's an imbalance for a period of time. And psychologically, the market doesn't like these announcements. People sell. So keep that in mind as a trader. When you get that announcement, as a short-term trader, for me, this is the worst. I mean, earnings, I know the earnings are coming. I can get out. Or if I hold, it's my own fault if it goes down. These secondary offerings come out of the blue. Normally, in an uptrend, you think you got a great stock, and usually the carpet gets pulled out from under you. Now, I mention this because there are 3 companies that reported today that they're going to have secondary offerings. One is NSTG, NanoString. Now, this stock gapped down, has rallied back. I would venture a bet. No guarantee. Don't rush out and short it because Tom guarantees you something. I'm not guaranteeing anything. But I would venture a bet that this thing does not close up today. It's up 4 cents right now. I'd be surprised. It would go against the grain of what normally happens with these secondary offerings. And I didn't look closely at the secondary offering. I didn't see, is the company getting proceeds? What are they doing with the proceeds? I didn't do any of that evaluation. SWTX also announced at a high. They come down initially, they're rebounding. Now remember, when they announce, everybody wants to get out. So who's on the buy side? Market makers. So why would the stock rally initially? I want to go back and I want to show you intraday chart on FRTA, and we'll go to an hourly chart. Do you see the initial gap down? And do you see it rallied for a period of time? Didn't quite get up to the opening price, but it rallied initially in the morning, and then look what happened afterwards. Again, I'm not saying that's what's going to happen to these stocks. It's what I would be very concerned about happening to these stocks. With a secondary offering, if I got a stock and it got a rebound like this, I would use the rebound as an opportunity to sell. The last one I'll show you is GH. Oops. And GH also announced the secondary. Look at this, gapping down, rallying back in the morning. Not good news. Also trading at a high. This is when these companies come out and they get these secondary offerings. Rarely do you see a company go down for 3 weeks, drop from 90 to 60, and then announce they're going to have a secondary offering. Why would you do that? Why would you just watch the value? At that point, I would hope you'd think your company's worth a lot more than that. So you wouldn't want to issue. Anyhow, that's all. I spent way too much time on that. We're going way over. I just wanted to point that out because if you see, you get wind of a secondary offering, a lot of times what will happen is you'll get the gap down. Of course, market makers are on the long side at the open. So sometimes you'll see that morning rally. I would use that morning rally to get out personally. That's what I do. And sometimes it keeps going. Market can be cruel. And maybe, it gets me out of position, but I'm always trying to manage my risk and just beware that there's a lot of risk in these companies when they announce these offerings. Cisco, the 3 you must see. I just wanted to point this out. Don't try to be a hero. Cisco has been trending lower for a while. If you look at it relative to the telecommunications equipment, it topped back in May. So it's been moving lower versus telecom equipment companies. And telecom equipment companies have been falling apart relative to the S&P. So when you get a stock like Cisco coming up and testing its 20-day moving average, I would be really careful. I don't know what it's doing today. It's probably up a little bit. Maybe it's testing it again. Yeah, it's up. Try and get close to that 20-day. But it's in a downtrend. There are too many other good stocks. I hear people say, well, Cisco's such a good company. It's, been a great performer for a long time. And, when I go back and I look at the stock, look at where it was in July of last year. It was already going low before the pandemic. It has not gone back above the pre-pandemic highs. And now it's rolling over again. Look at the volume trends, all negative. I stay away. I don't try to be a hero and catch the bottom. If you can do that, that is awesome, and I would stick with it. If you're good at calling bottoms, do it. That's not what I'm good at. So I stay completely away from companies that are downtrending. Next up, and this is a great company. Cisco is a great company, by the way, just not in favor. Travelers Company, another great company. It's property and casualty insurance company, been downtrending ever since that move up in June. Remember I told you the 10-year treasury yield was rising. A lot of these companies that were beaten down with the pandemic came roaring back. Well, look at what happened since. Money is rotated away from them again. Now with this big move up in the 10-year treasury yield, Travelers still can't get through its 50-day. Look at its AD line moving down. Look at relative strength versus its peers moving down. Look at its peers relative to the S&P moving down. Stay away from these companies. Great long-term company, but why not wait until they start to outperform, until money actually starts rotating into the group and into the stock? Right now, I think it's way too early to try and jump into a stock like this. Boeing, I mean, this is like the poster child. Look at the AD line. I mean, it hardly even gets a pop. They keep coming out in the news. Yeah, this is improving, the 737, we got a new order. I just ignore the headlines. Look at the charts. Follow the charts. AD line getting hammered. There's your move back in June. Look at this move with the 10-year treasury yield now. Still in a downtrend. Big reversal here. Yes, it's up today. The market opened up. Aerospace, Boeing relative to aerospace has been downtrending, and aerospace relative to the S&P is near a 52-week low. Bad group, bad stock within the group, bad AD. There's just too many things here that say stay away. I know it's a great company. Everybody, oh man, Boeing used to be 350, used to be 400. I can get it for 160. And some might say, well, yeah, but I got in at 90, so there, I got in at the bottom. That'd be great. But yeah, it's gone up $70, which is, hey, if you can time it perfect. But I can tell you, there were a lot of other stocks that if you timed perfect back in March, did a whole lot better than Boeing. I mean, this was great. Don't get me wrong. I mean, if you can time that, that'd be a great return. But my point is, Boeing has not been a leader. All right, that is it. Let's take a quick look at the market. This is probably the longest Trading Places live show in history. I apologize. But let's see if we can get that. Come on. It's trying. It's thinking. Maybe. Oh my gosh. Maybe I can try a different one. I'm trying to give you an update. I'm going into my other computer to see if I can get stuff up. Okay, I got it over here. So the Dow Jones right now is up 326 points. The S&P is up 40. NASDAQ up 150. So on a relative basis, the NASDAQ actually is outperforming the Dow and the S&P. Small caps, mid caps, both doing pretty well though. Small caps up 1.25%. Mid caps 1.4%. So mid caps actually the leader among all the different groups. So anyhow, that is it for today. I'll be back tomorrow with a recorded version over at Stock Charts for your next Trading Places Live. Everybody have a great day and take care. See you tomorrow. Happy trading.